The weird part is when you start looking at the numbers and you go, okay, we did a $50,000 lump sum deposit because you look at compounding and doubling. That means when she's ready for school at 18, 19, 20, if she chooses to go to college, which that's a whole different situation or subject.
Yeah,
right?
that's
We won't get into
exactly
that.
right.
But she'll have plenty of money there. If she chooses not to touch it and it goes out for 65 years, it's something like $16 million.
Jeremy, thanks so much for coming on the show today.
No problem. Glad to be here. Thanks for having me.
Yeah, of course. So, we've worked together on transactions. You're a mortgage lender. We've raced cars together. That's our joint,
I don't know
passion.
if we've raced. I've followed you.
Well, or, vice versa. But either way, we've had fun on the track.
Yeah.
But what I really like about your business model is your focus on education and financial literacy. You've been in the industry for decades, and I would like our focus today to just be centered around that and help to educate clients, whether you're renting or you're a homeowner, or you're trying to figure out your retirement for the future. I'd like to just go through and help people understand ways that they can focus on their financial planning and how real estate relates to that.
Yeah, I love it. I've been excited about having this conversation with you since we talked about it, because I think that it's missed, right? Like a lot of us don't really understand it, what to do, how to do. So it's going to be a fun conversation.
Yeah.
I'm excited.
Anyone at home watching, if you have questions, Jeremy will be linked below. Feel free to reach out to him. He's always happy to help. And I think you'll really learn a lot. Let's talk about this simple but very powerful rule, the rule of 72.
Yeah.
What is that? Explain it in simple terms, but it all relates to compounding interest, right?
Yeah. So the rule of 72 is really just a mathematical equation to really keep it simple to understand how often your money's going to double when you invest it.
Okay.
Right? So you really take 72, you divide it by your rate of return, and that will tell you how many years it takes for you to double your money.
Okay.
So as an average, you can look at some compounding interest and how you invest and go, okay, what is this money worth in the future? Because every dollar you save is a point of your freedom in the future, right?
Yeah.
But it's hard for us to recognize that the money we're saving today and the value of it in 60 years based on compounding interest, which is a whole nother thing. So it's a very simple task. Like, for example, if you get a 10% rate of return, if you invest $1 when you're 20, that dollar is worth 88 when you're 65.
Wow. Just that $1 from 20 to 65 has
doubling.
Become $88.
That's correct. Because at 10% rate of return, based on the rule of 72, it doubles every 7 years.
Wow.
And it doubles and doubles and doubles. And it starts to ramp at the end, around 45, 50, it starts to really ramp.
Because every time that doubles, then that number doubles.
That's correct.
And then that number doubles.
Yeah.
And that's the compounding interest.
Yeah. And that's where people kind of miss the value of that compounding interest, because it's really hard today to go, okay, I'm going to invest this dollar, whether it be 50, 100, 200. You can nibble away at that over time, but you got to start early. That's the key. Time has to be on your side.
So, and we'll get into that, of ways that maybe if someone's focusing on their retirement later in life, ways that they can expedite that process,
100%,
jumpstart that process.
Yeah.
While we're talking about the compounding interest and savings, how can a person use that either for saving for a down payment for a house or paying down debt, for example?
Yeah. So really what it comes down to is dealing with the money and where you're going to put it, right? Whether it be a simple savings account, whether it be some type of brokerage account. Now, like you, I'm not a financial planner, right? But we talk about finance all the time in what I do. We can look at a makeup of a client and go, hey, what about looking at these different avenues of, investments or different things to get ready for home ownership? Yeah. So it's really important. So that rate of return becomes important depending on how soon you want to use it, how long you have to save for home ownership. And then paying off debt, that's a little different of a thought, because in paying off debt, you have to have a strategy around that and how you want to do it, and then attack that with no holds barred budgeting. Like, let's get the debt paid off
and be consistent.
100%. You got to be consistent,
because you got to follow through with it. Yeah.
Yeah. It works negative. Think about a credit card when it's at 20%. Mm-hmm. The reason that debts continue to go up and balances continue to go up is because you're compounding interest the wrong way.
Yeah. Yeah, exactly.
You're paying interest on the interest.
Yeah. Yeah.
So it works both directions. That's the frustrating part.
Yeah. And that's something that's probably a lot of people don't even take into consideration.
No.
Is that it can be good, but it can also be really bad.
100%. And I think it's important to understand the lifestyle and what that means to be debt-free, right? Yeah. Some people want that. Some people don't. There's no perfect path. Yeah. It's the path that you're on, and just as long as you walk it.
Yeah. And the one that you'll actually follow through with, right?
100%. Yeah. Because people, or one that you'll stay on.
Yeah.
That's another good one too, because people tend to switch paths and they go different directions, and that really hurts retirement in the future.
Something that you mentioned, we are not financial advisors, but what I like that you've done is you've taken personal experience and you've applied it to your business, and you can give a client anecdotal evidence based on what you've experienced of how you've tackled a budget or how you've approached, your daughter's savings for college.
Yeah.
I know that that's something we've discussed, quite a bit because you've had a different approach to that.
Yeah. So we use the idea of compounding interest and that idea of rule of 72 and move some of our investments around to put a one-time lump sum deposit in our daughter's account for college.
Yeah.
And the weird part is when you start looking at the numbers and you go, okay, we did a $50,000 lump sum deposit, because you look at compounding and doubling. That means when she's ready for school at 18, 19, 20, if she chooses to go to college, which that's a whole different situation or subject.
Yeah.
Right?
That's
we won't get into
exactly
that.
Right.
But she'll have plenty of money there. If she chooses not to touch it and it goes out for 65 years, it's something like $16 million.
Wow.
Right. So imagine funding your children's their entire retirement fund with one deposit. And we didn't just come up with the money. We just moved it based on our goals and where we're at. So just the thought that that's how powerful that money is when they're young. So do it when they're born, 65 years.
Yeah.
That's a long time.
It's a long time. And that small amount becomes a huge amount.
Yeah. And we have to use the past to predict what we're going to do for the future investments. Right. Yeah. And we have to watch it and we have to pay close attention to it, but we don't really know. None of us know what the future holds.
Exactly right.
But we can be prepared for it.
Yeah. Yeah. That's huge. Yeah. That's huge. So, I'd like for us to talk about a lot of people, whether you're talking to an agent or a real estate agent, or you're talking to, some of these financial advisors on YouTube, there's differing sides of opinion on renting versus owning.
Yeah.
And there are certain people that believe that if you're renting, you're just throwing money away. There's others that believe if you are buying a home, that you're just throwing money away.
Yeah.
So what's your opinion on that? And, I'd like to dig into that from the financial side of when does it make sense for someone to buy versus rent? Because that's a conversation that I have pretty regularly with clients.
Yeah, I think people are always surprised by my answer to that question because being a loan officer in the mortgage industry, we don't get paid if we don't do loans. So people just expect I'm going to tell them to hurry up and buy.
Yeah.
And I think that home ownership has to be at the right time in your life. And nobody can tell whether that time is right or wrong, except for that person's situation. Right. Yeah. But I do believe that they have to be ready for the payments. They have to be able to afford the payments. So affordability is a key part of this. It's also navigating through what their investment strategy is and why they're buying a home.
Because it's kids? Exactly right. It's everything. Not always financially driven for why someone buys a house. There's an emotional component to it. They're living in a 1-bedroom apartment and they're having a baby.
Yeah.
They need more space, or they want their landlord saying, hey, we're selling the place and you have to vacate, or I'm moving into the house, or I'm redeveloping it. So it gives you, when you own your house, you can control your destiny a little bit more.
Yeah. You control the environment too, which I think is extremely important when you're growing a family and you want to control that environment.
Yeah.
And home ownership doesn't have to be the best investment when that's something that you want for your future, for your kids, for your family, for generations behind you. Home ownership can be simply that. It doesn't have to be what you see online where everybody's investing money and I'm going to buy apartments and I'm going to do this and it doesn't have to be that difficult. Let's start with the basics, make sure it fits, and let's make sure that it's exactly what you want to do.
Is there an example of when renting does make more sense financially as opposed to buying for someone?
Yeah, I think a lot of times it's affordability is first and foremost, but it's also like, how old are you?
Yeah.
Like if you're in your 20s and you have to be mobile for your business, or you're not going to be in a certain area for a certain length of time, there's so many reasons why you wouldn't want.
Or you don't even know where you want to live.
100%. If you're moving to a new area and you don't know the area, do you really want to take the chance and buy a home, but then not like it and have to move it again?
Yeah,
that's
exactly
one of
right.
the worst things you can do.
Yeah.
And I think that it's really important to plan that accordingly. So I think when you're younger, it's not nearly as important.
Yeah.
But if you want to and you need to, then great, buy a home. But no, it's not a financial thing. It's more of a, hey, I want to do this.
Exactly right. Just because it seems like the right fit at the right time.
Yeah. Yeah, that's exactly right. Now, there was a time in my life that my home was my sanctity. It was my safety, right? And if I didn't have my home, I don't know what I would have done without it, right?
Yeah.
So as my futures progress, I've always been a homeowner, but I own a very simple home because it's not everything to me. It's just the home base.
So is there a time, in your opinion, when there's kind of a tipping point of when it goes from, okay, this is maybe the good time to rent, and now this is when it should pivot to home ownership?
Yeah, I think that as you get older in life, depending on where you're at financially, home ownership becomes a really important part of leverage.
Exactly.
Right. Like you as we get older, you may not be able to save to make your goal.
Yeah.
Right. We have to think differently and go, okay, how do we use some leveraged assets to be ready for the future?
And we're going to get into that point of how to maximize leverage from a real estate standpoint. I think it's also important to think about equity and appreciation. And when you do get to a certain age, taking into consideration, okay, what is my retirement plan? I can buy a house that's this size. It's perfect for my family. This neighborhood is seeing appreciation annually of, X. And if I stay in this house for this long, realistically, here's where the value may be. I can sell it. I can downsize. I can transfer my property tax basis.
Yep.
And now I've got cash available to me. And from a retirement planning standpoint, there's probably a lot of value to that.
Yeah, there definitely is. Another place that's really important too is if you're not a saver.
Yeah.
Right? Like we have to think differently about how we're spending money.
Yeah.
And what I find in my 20 plus years in this business is some people are savers and some people are not.
Yeah.
95% of people I work with aren't great savers, right?
It's not easy.
No, it's not easy. It's one of the hardest things we do because you have, if you haven't heard of it before, lifestyle creep, right? Like as you start making more money, you start spending more money, your lifestyle creeps. And it happens in renting too.
Yeah.
So another reason that home ownership becomes really important instead of renting is if you can't hedge against yourself. I think home ownership is one of the most important hedges against humanity.
Yeah.
Because our human nature is not to save for the future. We don't understand that part. So if you've been renting for 20 years and you haven't saved for the future, that's probably a pretty good indicator that you got to do something.
Yeah, exactly right.
And if you're going to, let's say you have a home.
It's a forced savings account, basically.
Yeah. And if you have your home and that's your biggest forced savings, if you lost a job, like would you go and get another job right away to pay the mortgage?
Yeah, of course.
If you needed 2 or 3 jobs to pay the mortgage, would you?
Probably.
Okay, but let's say you're behind in retirement, don't own a home.
Yeah.
Okay. Will you get a second job just to put money in retirement?
Just to start saving? Not likely.
Yeah. Or a third job because you really have to accelerate it?
Yeah.
Or what happens if you get in financial trouble? Like the first place you would go would be, if you don't own a home, is going to be to investments. But you know how long it takes for people to save their first $100,000? That's the tipping point of savings.
Got it.
So if they all of a sudden go to that money and they pull from it.
Good luck trying to build that up again.
And it stops. You set yourself back decades.
Yeah.
And that's something people don't realize. In home ownership, let's say you do a home equity line, you pull equity out to save yourself from a major catastrophe in your life.
Mm-hmm.
Well, the home still appreciates.
Yeah.
Right. It's still a value. It doesn't go away based on what you owe against it. And people don't think about that kind of stuff.
And you'll do what you can to pay that debt off.
100% because you want to, well, it's a roof over your head.
That's exactly right.
Right. And that's where it becomes really valuable. It's one of the best hedges that we can have to protect ourselves from ourselves.
Well, and I think that's a great point just because, like you said, someone's going to make sure they're making their mortgage payment every month. That asset is appreciating annually, monthly, daily. It's going up in value. And if you said, okay, well, I'm renting, paying $2,500 a month, I should be putting away $1,000 a month in my savings account. But that $1,000 a month gets, moved to the side because I want to go on a trip to Hawaii. You're better off with a $3,500 a month mortgage payment because it's for savings. You're paying down the debt on that property. Yeah. You're building your equity. You're seeing appreciation. And if the time ever came to sell that house, well, you're going to end up with cash back to you, hopefully when that time comes.
Yeah. And the gap here in San Diego is bigger than that. Right. Yeah. So when you think about San Diego, your rent is $3,500 or $4,000.
Yeah.
Your mortgage payment is $6,500 to $7,000. Right. Yeah. So you're talking about a $3,000 gap. Now, I've played with the numbers a lot, and I said, okay, what if I didn't buy a home and I saved $3,000 a month?
Yeah.
Instead of buying $1 million home with 10% down, if you run those numbers side by side, the amount of money that you would have is essentially the same in 30 years.
Interesting.
Right. The problem with that is it doesn't take into account
tax benefits.
Yep. Tax benefits or our human nature of spending money.
Yeah. Of that trip to Hawaii or the emergency or
kids
exactly
need a car, something changes, you take on more debt. Like we don't know.
Yeah.
That's why, if you start early enough with compounding in that gap, you don't really need to be a homeowner to be successful, but most people can't save and they spend.
Yeah. Well, and then depending on what your income is, we're not financial advisors. We're not accountants,
right?
But there's tax benefits to owning your home.
Yeah.
You have certain write-offs for mortgage interest, property taxes, things like that.
Yeah.
So it's more than just what your monthly cost is. There's also a savings at the end of the year.
Yeah.
And, that's something else to consider when you're weighing out your options.
Yeah. When we look at approvability and we go through the loan process, we have a pre-purchase consultation that we talk about that. So we cover tax benefit, current assets, the rate of return, compounded interest. Like we look at that as part of the package.
Yeah.
We can't give advice there, but we can look at it and go, okay, this is about what it looks like. And it's been super valuable to review that with clients.
When you're doing that initial consultation, are you looking at putting 5, 10, 20% down? Here's why, maybe you should put this down and maybe save that money. Don't put it towards a down payment, save it and reinvest it somewhere else. Like, are you going through that whole process with them?
All the time. I can't tell you how often people come to me thinking they have to put 20% down.
Yeah.
Right. And you look at it and go, well, what if you didn't? How old are the kids? Where are you at for college funds? Where are you at for retirement? And you go, what if you didn't put 20% down? If you put 10% down, your mortgage payment is a little bit higher. But if you put 10% in any type of index fund, you can kind of play around with the numbers and rate of return.
Yeah.
And that idea of 72 and go, okay, this is what it looks like in 60 years.
Yeah.
If you do that, the wealth that you build is significantly higher, because what people don't realize is putting 20% down is more risk to them as a consumer compared to putting 10%. I'd much rather give the risk to the bank.
Well, and I think for some people, it's going to depend on that specific situation. Some people say, hey, I want to put more money down because I want to guarantee that my monthly payment is X, or I'm getting a gift from a family member, which is now very common with the baby boomer generation who has a ton of cash saved. They're coming to the table and saying, hey, we're willing to give you guys a gift, our kids or a family member a gift, to be used towards this. If the person said, well, how about I take $100,000 and invest it into something else that you were going to give me, that likelihood may not be there.
Yeah.
So I think it depends on the situation, but that's most mortgage brokers, lenders don't have that conversation with clients.
Yeah. It's about getting people pre-approved, get them out, look at a home. I think there's a strategy there that's super valuable. And I've been in that situation with gifts before, and it amazes me when you start talking to mom and dad and you say, hey, have you guys thought maybe we could do it this way? And they go, I never thought of that. Like, what if you didn't give them so much and we did it this way? And you left it with your financial planner. What does your financial planner say that money's worth in 20 years?
Interesting. Yeah.
Because I'm in a situation that's very similar right now where mom and daughter both own their homes outright. Mom's in her mid 70s, daughter is in her mid 40s, and mom has some medical stuff that needs to be done. Yeah. But all they have is equity.
Yeah.
And now I'm having a hard time navigating through the equity stuff. So it's important to have the conversation with the people around you.
Yeah. Yeah. And that can get difficult. That sounds like a difficult situation of trying, especially if you don't have income.
Yeah.
And you can't pay off a home equity loan or line of credit.
Yeah. And people will jump to reverse mortgages or different loan products. But if the plan was different from the start, it would have protected their family a bit more. But it's generational. Yeah. Right? Like the generations in front of me have always thought of, I got to pay my home off. That's the goal.
I mean, that's always even, I'm 40 and that was always what I was told.
Yeah. Me too.
Pay your house off, have that. So it's not a concern and, probably not from a savings standpoint, just pay it off so you don't have to think about it.
Yeah. You just take all the risk when you pay it off, and people don't understand that because the market goes up and down. So if you're looking at it as an investment asset, like it's going to move up and down and move. Yeah. Well, it's all your risk. You own it.
Yeah. Yeah. And all your cash is tied up in your house.
All of it.
Yeah. So let's shift a little bit. I'd like to go back to something you mentioned before. You talked about leverage. Yeah. And as it relates to real estate, explain that to me. And I know this is a big topic in your financial literacy courses.
Yeah.
What is leverage? How does it relate to real estate? How can people take advantage of it?
So leverage is simply using, somebody else's money to make money, essentially. And that's when I think about real estate, I kind of think of it that way.
Yeah.
So when you think about leverage, when you have a loan on a property, you're leveraging that property to make money, essentially. Right. So let's keep the numbers really simple.
Yeah.
Let's say it's a $500,000 home.
Okay.
And you have 5% down. That's 25 grand.
Yep.
Okay. Let's say that home appreciates at 5% for the next 5 years.
Okay.
Right. That makes the home worth around 600 grand, give or take.
Yeah.
Okay. Well, would you rather give me $25,000 to make 100 grand? Or would you rather give me 20% down, which is 100 grand to make 100 grand?
Yeah.
What's a better rate of return?
Yeah, obviously. Putting the 25,000 down.
Right. The home doesn't care how much you owe against it when it comes to value of it.
Yeah, and appreciation.
So a leverage asset is essentially leveraging what you can to grow the appreciation on that home.
Yeah.
As much as possible.
Yeah. So let's use that same theory for someone who's older. Maybe they own a house, they own their house, but they're thinking about buying an investment property or buying a rental property because they don't really have any savings.
Yep.
And they may say, hey, I've got $100,000 that's just sitting in a high yield savings account. And I want to buy something that's at least going to cover its cost monthly, but I want to take advantage of the appreciation.
Yeah.
Is that the time when you say, okay, great, let's look at taking advantage of leverage and let's jumpstart your retirement?
Yeah. So my first thought in all of those situations is, where are they in retirement?
Yeah.
If they're behind in retirement, the question is, what are they going to have to do to catch up?
Yeah.
And is it feasible? Right? If it's feasible.
Yeah. Is it too far gone?
Yeah. Is it something where the goals are so lofty that you can't save to it based on the Rule 72 and based on the rate of return and based on your financial planner?
Yeah.
If you can't reach it, then how else do you plan to get there?
Mm-hmm.
And it almost has to be leveraged, because how else can you do it?
Yeah.
So that's where it becomes really important. Going, okay, maybe we can leverage this money into something different and navigate through that. So all the time you start with what the financial plan is and what it looks like.
Yeah.
And then if they're behind, then we got to talk to them about trying to buy a couple.
So give us some real life scenarios of when you've had a client come to you and this is one thought of how you can take advantage of leverage through real estate.
Yeah. So you started with a great example. So somebody in their mid 40s, early 50s, you look at kind of where they are financially. They have a good amount of equity in their current home because they bought their first one in their mid 30s, but they haven't really saved much for the future.
Yeah.
Then we go, okay, well, what's the plan? Can you increase your savings? And a lot of time the thought to that is no, because their lifestyle is kind of creeped.
Yeah.
And we go, okay, well, when could you do it? And you start having those conversations. And then you pick up pretty quickly that we need to get more serious. And then you do either a home equity line, you can do a cash out refinance, pull some equity from one property, use it for the next. Now here in San Diego, it's really hard to do that.
Yeah.
Right. You're typically
just because properties are so expensive.
Yeah. The rents just don't cover the cost of the property.
Yeah.
Currently, there's a disconnect there. So you could look at other avenues out of state. No problem with that. Right. Work with great people like you to refer great realtors out of the area.
Yeah. Now, what about kind of a outside the box thought of someone who owns their house? They've been in the house for the last 15 years and they decide that they want to accelerate their retirement, but they want to be able to buy another property as a new residence. So what if they bought a duplex or a triplex or even up to a fourplex, a 4-unit? They live in one, they rent out the other 3 or 2 or 1, depending on the size, and help to offset that mortgage. Because then aren't the loan rates different because it's a primary residence versus an investment? They
are. That'd be a really good example too of somebody doing that. But then what I find is they're downsizing at that point. They're trying to go, okay, as part of my plan, I want to not have to pay a mortgage, but I want to have somewhere to call home in retirement.
Yeah.
And in that situation, doing a 2, 3, 4 unit is really important. You could also look at doing joint family living.
Okay.
Right.
Like building an ADU or something like that.
Yeah. Because one of the biggest risks to our future is our parents.
Yeah.
Right. We've talked about that several times where we go, okay, what is mom and dad's plan?
Yeah. Yeah. And do they have savings in place, or are we the ones that are going to be taking
because if you're going to take that responsibility, it might be time to think about how mom and dad are currently using their equity to make sure you're ready for the future. And you should be having those conversations, which is kind of taboo. We don't talk to mom and dad about money.
Yeah. So let's say hypothetically, mom and dad live in a house, or, family member lives in a house. The house is paid off.
Yep.
And they say, look, I can rent my house for $5,000 a month. We can build an ADU on your property or convert the garage, and that's going to cost us $100,000. Do they borrow against the house to do that? Do they pull from some investments, or like, what's the way of finding that money to build that, so then they have a place to live and then you can rent out their house if you don't want to just go and sell it, or I guess you could sell it and reinvest that money.
Yeah. So if they want to keep the current house and it's a suitable living situation, pulling equity from a home always makes most sense, because remember, when you pull $100,000 from your house or $200,000 from your house, the house still appreciates.
You're exactly right.
Right. It's still leverage. It doesn't matter what you owe against it. It's still going to gain value.
Yeah.
If you pull it from investments, you have to look at what that money's worth. If you're getting a 10% rate of return, that $200,000 in 10 years is worth $400.
Yeah. So
20 is worth $800.
So don't touch that investment.
If you can, then don't, right?
Yeah.
Because also in retirement, mom and dad need money. They need liquidity.
Not exactly equity. Right. That's exactly right.
That's where you have to be careful with that. So the other option is going, okay, we're going to sell both homes.
Yeah. Yeah. Sell both homes, take that money, buy something that's suitable, and reinvest the difference.
Yep. Downsize mom and dad, have something with an ADU where they can live in that. Maybe their goals are to travel more. Maybe it's really important before you're looking at refinancing or repositioning, you really understand what you want to do in the future.
Yeah.
Like, why would you refinance and sell in a year?
Yeah, exactly right. Exactly.
So think about it a little bit and plan for it.
Yeah. Yeah. Because there's a lot of different ways to approach it. And so just each person's unique from that standpoint. So understand what the plan is. And
having great guidance to go, look, why don't we look at this a different way?
Yeah.
Which is what I do really well, like what you do really well. Like the whole thought is you want to do this, but what about if you looked at it maybe this way?
Yeah. Creative thinking.
Yeah. And by doing that thinking, you make sure you get them back to their financial planner, get them back to their tax person. If they don't have those people, we refer them.
Yeah.
We do all that stuff to try to do what we can to protect them.
Well, and I like the idea, like you made a comment about parents, maybe they just want to go travel.
Yeah.
It may be the perfect scenario where they have a home base that's a lot smaller and they can kind of lock it up almost as if it was a condo. And if you have the relationship or you have the space and you would want a home base at your house also, then that can make sense. And then they don't even have to think about it. And maybe their other property that's continuing to appreciate, they rent it out. And when the time comes to sell it, or if that's part of their inheritance plan for their kids, then great. The kids get it, eventually. Yeah.
And it works great for that. A lot of boomers are moving not because they have to, but they want to be next to grandkids.
Yeah. Oh, it's a huge statistic of the amount of people that are moving closer to their grandkids.
Yeah. So the question is, when mom and dad are moving closer, what's their plan? And I think we have to get away from being afraid about talking about it and just asking the question and being like, okay, like, let's have a serious conversation.
Yeah. Take the emotion out of it. Just matter of fact. What's the plan?
I do it with my mom or my mother-in-law, and we have these conversations, and it's such a weird thing because, they're not used to talking about it.
Yeah. Yeah. That's exactly right. That's exactly right. And that's something that has to be discussed.
Yeah.
Just the same way as you have to discuss, setting up a trust and, focusing on that for when you get older, you got to discuss what your actual plan is and put that in place.
Yeah. Think about the generations behind you by having that conversation and the wealth impact you can have on generations to come.
Yeah.
We just don't think of it that way because we're not thinking about every dollar being a piece of freedom.
Yeah. Yeah, that's exactly right.
Because as we save for the future, it gives us more freedom. So why not create more freedom for the generations behind us by simply having a conversation?
Yeah, exactly. And I think that's in part of having that conversation. It's with your family members. It's with financial advisors. It's with other experts in the various industries to understand that homeownership really is worth it. And obviously I'm biased in my opinion. I own my own house and, we have investment properties, but it's because I do believe in real estate as an investment, not just for peace of mind of, controlling my home, where I live and keeping the roof over my head, but I do believe it's a good financial investment.
Yeah. I think what you're kind of also saying is you need to have a good financial group.
Yeah.
Like, who's your financial people?
Yeah.
It doesn't matter how much money you have. You can have those people, tax, CPA, financial planner, realtor, loan officer, trust attorney. Like you should have this group of people that you can always go to and trust.
So, and I think that's a perfect point to note of you have that team and working and communicating with them is how you can decide if buying real estate, owning real estate, investing in real estate is the right fit for your financial goals.
100%. And if it's not, don't do it.
Yeah.
And you and I are very similar that way when we go to, this doesn't make any sense. We shouldn't be doing this. And tell somebody, hey, hold on.
Yeah. I mean, I've talked myself out of a job on more than one occasion because it wasn't the right fit.
Yeah.
And sure, they could have qualified for a property. They could have bought a property, but to me, it seemed obvious that they were either trying to force the situation or they were doing something that seemed like a good idea, but long-term, I knew that it was not the right fit.
Yeah. I think you have to match up with people that are in a servitude mindset, right?
Exactly.
We don't
right.
sell, we serve.
Yeah.
I happen to do mortgages, but my passion is serving, not mortgages.
Yeah, exactly right.
So I'll have any conversation with any client about anything, and they're always surprised when we have a conversation about finance. Like, well, what are you going to charge me? I'm like, nothing. It's just let's just talk.
Yeah.
And they don't believe it at first, but as they get to know us, they go, oh wow, they're not like they want to help.
So are there any myths or anything that you hear on a regular basis when clients call you that just drives you crazy?
You know, the biggest thing is down payment is a big one, right?
You got to put 20% down.
You got to do whatever, right? That you have to be a homeowner to make it. Like, I think that's something too that's changing.
Well, it's always been part of the American dream that you own your own house.
Yep. And I think it's still super important. I think it's part of a financial plan. So it's something that we need to be doing.
Yeah.
But it needs to be at the right time. And then, lastly is really dealing with whether or not you should be pulling money from investment accounts to buy real estate. I get that question a lot. Like, I have my 401k, I'm going to pull money from this to make this happen. And that's a really tricky one because, once again, it depends on age and their situation, and
what their goals are.
That's correct.
Right.
Yeah.
Because
100%.
maybe they've decided, okay, I'm going to pull from this to buy that. And this is part of my dream of what I want. I want to have a house in Hawaii or whatever the case may be.
Yeah.
And just know that if you do this, here's the consequences, good, bad, or indifferent.
Yep. 100%. Just make sure you know what it is. That's all. I'd say the last one is definitely rent's throwing money away.
Yeah.
I don't believe in that. I don't think it's throwing money away. I think there's a fine line that there's a time in all of our lives where we rent it, right? If we would have understood why we were renting a little bit better, we probably would have made better decisions.
Yeah.
But a rent is like the max payment. Yeah, it can adjust every year, but what happens when something breaks?
Yeah. You call the landlord.
You call a landlord.
Yeah.
What happens? Like, it's the maximum payment you're going to pay.
Yeah.
A mortgage payment is just the beginning.
That's a very good point.
Right? Because you have maintenance, you have all the different stuff. So you have to be prepared for that too. And people that aren't factoring that in, that's a bit of a problem. So just watch that stuff.
Yeah, that could get pretty scary.
It always gets scary.
If you don't have a reserve account and you're not, putting money away, knowing that eventually, there's a useful life for a roof and for an air conditioning unit and all that kind of stuff. Eventually it's going to pop up and it's an expense that the owner is going to have to take care of.
100%.
And then, last question before we jump off. What's your response when people say, I'm trying to time the market, or I'm waiting for interest rates to go down and then I'm going to start buying? Or how do you respond to clients when they say that?
I don't think you can time anything. That's like me saying, I'm going to time my investment strategy. I'm going to wait for the market to be the best.
Yeah.
Right. If you look at people,
buy low, sell high.
Buy low, sell high. If you look at people that do that, they typically lose more money than they make.
Yeah.
Right. Because they're trying to time something that's not timeable. In home ownership, it just has to be the right time for your family. And there's no right or wrong. I think if you look back in history, there's only been 4 times that the market ended negative. 2 of those times were 8, 9, I think.
Yeah.
Right. So over the many years, it hasn't, like, how do you time it?
Yeah, exactly right.
You just can't. And I think if you can afford a home, it fits in your budget, you can't time it.
Yeah. Well, and I think that's a conversation that I have all the time with clients is we're not trying to time the market. If you find a house that you love and it's the perfect house for right now and you can afford the payment, then you should do it.
Right.
Because no home is perfect. I made a video on this note that no home is perfect right now and the same house is perfect in 40 years. You need to focus on what your priorities are now and how that works for your plan.
Yeah. And it comes into planning.
Yeah.
Right. When things get emotional, people make really bad decisions. Think about how many times you've gone to a car lot and you go, I'm just going to look.
Yeah.
And you go home with the car.
Yeah.
And then you go, man, I didn't really need to do this.
Yeah.
Right.
Yeah.
Like people need to plan better for it. And if they plan better, it would make the home buying process so much easier and you wouldn't be trying to time the market.
Yeah. And then you're also minimizing a boatload of stress.
Correct.
That comes along with it. And you may make decisions that because they've been well executed or well planned, they're well executed and you're happy with it. There's not a regret, buyer's remorse after the fact.
Yeah. I mean, another way to look at it is what if you bought a home in 2008, would you be angry today?
Yeah, exactly right.
Probably
You'd be
not.
stoked. Yeah.
You'd be like, man, I wish I wouldn't have bought at the height of the market. Right.
Yeah, but that house is still probably doubled in value or quadrupled.
With time,
yeah,
everything fixes itself.
Yeah. I mean, I bought a house in 2011 for $399,000. That house would now sell for $1.2 million.
Yeah. That's crazy.
And that's, and even if we go back pre-COVID, because those few years were a little crazy from the market for the market in San Diego. I mean, that house was still an $800,000 house. So it really just goes to show having that consistent appreciation. And especially, I don't look at the market nationally nearly as much as San Diego, which is such a micro market in and of itself.
It is.
We've stayed insulated and we've continued to see great appreciation. So yeah, for real estate in San Diego, I think it's always a great investment.
Yes.
Yeah. Yeah. Perfect. Jeremy, thank you so much for coming on.
Thank you for having me.
Look, I hope you guys have enjoyed this conversation. Jeremy is a wealth of information and all of his info is going to be below. Please reach out to him. He's happy to help answer any questions that you have. Have a great day. This is great.
Thank you. This was a lot of fun. Thanks for having me.
Thank you.